Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachordes, and joining me is investment analyst Cristina Parthenido. We'll be taking a look at the Bank of Canada's policy meeting and the outlook for the Loonie. So Cristina, on Wednesday, Tiff Macklem, the Bank of Canada's new chief, will hold his first policy meeting. He's taking charge at a difficult time. GDP readings that were released last week showed that the first quarter had the worst contraction since the financial crisis. What should we expect, and how might things develop for monetary policy during the post-lockdown period?
Hello, Maria. Well, the global economy had a tough time in the first 3 months to the year thanks to the COVID-19 lockdown, and Canada is not an exception. Actually, we may see a larger decline in April because restrictions took effect in mid-March and were fully in place until the government decided to gradually remove them in May. But what is more important now for the markets is how the economic situation will evolve in the post-lockdown phase. Eventually, we will return to normal life at some point, but current expectations are that this may take some time to happen as long as the drug trials continue to look for an effective vaccine. So it's a one-way path for monetary policy, and since economies are operating at limited capacities, central banks should be prepared to release additional stimulus regardless of who is the chief of the bank. However, this reopening phase, I think it will be wiser for policymakers to let the economy absorb the existing programs and instead keep the powder dry in the main policy tools for more difficult times, for example, in case of a second wave of infections. Negative interest rates have been increasingly discussed after the massive stimulus packages were delivered in March, but I don't think this could be a solution for a country such as Canada, which is strongly dependent on foreign capital. And as we all know, foreign investors would immediately withdraw their funds to avoid negative returns unless other central banks, such as the Fed, cuts rates below zero first. Besides that, the private sector is one of the most highly indebted in the world in Canada, and lower interest rates could only worsen the problem, especially in the housing sector. Now, what could the central bank do instead of lowering interest rates is to reduce the spread between government and corporate bonds by increasing its corporate and mortgage bond purchases. Nevertheless, whatever the bank chooses to do, it must ensure that the unemployment rate is falling, consumption is responding positively, and inflation is taking an upside direction in order to avoid a debt deflation crisis.
Right. Okay, turning now to the Loonie. It had an amazing start to the week against the US dollar following last week's gains. Do you think the policy meeting could further boost the rally?
Well, that may depend on the forward guidance the new chief will provide, since no big surprises are expected on interest rates and asset purchases. He hasn't spoken much about future monetary policy since his appointment in early May, so markets will pay a close attention to his communication style to determine whether he's a hawk or a dove. If he commits to keep interest rates steady by the end of this year, or at least reduces the case of negative rates, then the Loonie could find more room for improvement against the dollar. Otherwise, if the governor appears more concerned about the future of the Canadian economy than markets believe, signaling that negative rates could be possible this year, then the Loonie could probably give up the rally. But overall, I think the rate statement may be of a little surprise, so any movement in the Loonie could be short-lived.
Cristina, thanks so much. And thanks for joining us at xm.com.